Hi, David here. Good to talk to you guys, and just want to give you an update. A lot going on. Kind of seems like the never-ending story right now. Still the same issues, really. You've got high inflation. You've got the Ukraine war. You have now the Federal Reserve now raising interest rates, which we'll talk more about today for sure. You're going to hear terms like demand destruction, things like that you might not have heard before. And we're going to start discussing some of the real drivers behind the headwinds that are happening right now. Markets in themselves, technology is getting decimated. That's the biggest kind of headache for the markets right now. All the stocks that really were the kind of stay-at-home stocks during COVID that did so well, the Apples, the Amazons, the Microsofts, the Googles, Zooms, Peloton, but the big stocks are starting to have some trouble. Again, the NASDAQ's down 20% year to date. You have stocks like Facebook down almost 50%. You have Netflix down almost 70%. Google just reported earnings, a little bit of a miss. They'll probably end up being down 23% as of tomorrow. They're down 6% overnight. So, the market right now does not like highly valued stocks. So most people own the Apples, the Amazons, Microsoft, Googles, Netflix. And so a lot of people are getting hurt by that. There'll be a time when those stocks are a little better to buy, but right now that's kind of a problem and is really hurting the market in the short term. So they're being basically revalued, re-rated. Until that kind of stops happening, you're going to see the market have pressure. So that's on top of this whole, the Ukraine war, which really has spiked, the prices, consumer prices, commodity prices, oil prices, gas prices. So that's a real problem. That's not going away. Consumer price index was around 8.5% last reading in March, highest in 40 years. You're probably aware of this. The producer price index, which is the input cost of all the consumer goods that we buy, was up over 11%. These are really astronomical numbers. And so, we're all feeling that. The reality is, the stock market does not like high inflation. The stock market does not like a Federal Reserve that's raising interest rates. Right now, you have the federal funds rate that's running around, less than 1%. Chairman Powell seems to be really serious about raising interest rates, which you need to do to alleviate inflation. There's an old saying that higher prices is what caused inflation to go down. During the Paul Volcker era, for those of you who remember, during the 80s, he basically started raising interest rates and broke the back of inflation under Reagan. And, Jay Powell's used his name. So he's very serious about reducing inflation. We have to do that in order to get this economy under control, in the sense that, we have a strong economy right now. Unemployment's running at 3.6%, I believe. So the reason I think he can be more aggressive right now is because we do have full employment. But it is a headwind of the stock market. Again, inflation is a headwind. The Federal Reserve raising interest rates is a headwind. The technology stocks are not doing us any favors either. So it's pretty difficult right now. I think on the positive side, relative to, in the future here in the next few months, is I think as we get through these initial rate hikes, I think the market will accept that a little bit more than it is right now. The bond market is getting just destroyed right now. Fortunately for our clients, we don't own bonds right now as an asset class, but long-term treasury bonds are down almost 20% year to date. I think they were down as much as 19%. They've come off a little bit. Even like 10-year treasury are down around 10%. So typically, the typical 60-40 portfolio, is down over 10% just on stocks and bonds alone, where bonds are actually doing worse than the stock market. So it's just really difficult right now in the, looking at traditional asset classes, again, that we don't use in the bond side, where, the typical firms are looking to mitigate risk. So bonds are really not a safe haven right now. They're looking more attractive as we go forward here, as the Federal Reserve kind of stops raising interest rates. So we don't know exactly when that's going to happen, but I do believe the Federal Reserve is serious about taming inflation. It's one of their dual mandates. Part of their dual mandate is full employment, which we have, and the second is price stability. So really right now those are competing issues, because we already have full employment. So the Federal Reserve is really concerned about inflation. So really they're going to do whatever it needs to be done to really get inflation under control. I read a good article by a gentleman I follow quite a bit that I respect. And really, a lot of people feel this way that are smarter than I, that we may have hit peak inflation. The Russia-Ukraine war really spiked inflation in the short term. We also got these supply chain issues that came off the back of COVID. It's kind of like this perfect bad storm that's come about that's really caused these inflation spikes. So we may be at peak inflation right now. Now that doesn't mean that everything's going to be hunky dory, but we may go from, let's say, an 8% inflation rate to maybe the next couple quarters in the next year to down to 5, and then maybe over the next 24 months down to 3. Something more reasonable. Just some things that I've been reading about that I trust and respect. So we're probably coming off from kind of a rate of change perspective, maybe peak inflation. It doesn't mean it can't be persistent. Think of more like not deflation, but disinflation, coming from a peak high and still having some inflation, and that's showing up already in home prices. Well, really, it's showing up in I was reading an article relative to reduction in home price listing sales prices, as far as listing prices down, 10-15%, where a year ago you're having no reductions in listing prices. So that's coming off a little bit. Inventories are still low. I think I read we're average about 2 months of inventory. Balanced inventories around 6 months. So those are still keeping prices high. I think the real estate market is still strong. In the last year, you've seen home prices average about 15% increases. Over the last 2 years, about 35%. But these are part of the areas of the economy that the Federal Reserve is really trying to, again, that demand destruction I kind of was talking about earlier, is really getting this inflation under control. And part of inflation is home prices. If you're a first-time home buyer right now, you went from 2 3/4 interest rates in January to over 5% today. Right, I believe you're talking about 50 to 75% increase in the cost to own a home relative to putting 20% down on a house, and the increase in the sales price and an increase in the mortgage payment. So that's what the Federal Reserve is trying to do, is slow down the economy so we can deal with this inflation. So that's about it. Lots of things going on. As you know, we're always watching out for you. We're always looking at protecting capital first. If you have any questions, please give me a call. Thanks a lot.